Remember the sayings, bigger is better and lesser is more? Is it really in banking? That's the burning question for today. The number of banks have been shrinking dramatically over the past couple of decades. We're down to 4,200. And the conversation is in Americans' living rooms today because of the recent collapse of a couple of banks and the government's response to protect the uninsured depositors. I'm going to discuss two key reasons that I think we will always need community banks. One, they power local communities. And two, banking is going to get more expensive for all of us without the competition, but specifically for the hardest hit, the underbanked. So number one, community banks are critical to small local businesses. In fact, they dominate the commercial real estate and small business lending market. Community banks under $50 billion in size make 1.5 times more commercial real estate loans than the top 60 banks combined. And they hold $72 billion worth of small business loans. And why is that? I propose it was because of their relationship banking. It's a significant credit underwriting tool that they still use, which is relationships with the lender and the customer. They actually have a personal interaction. And the final decision maker understands the market dynamics, the local economy, the community needs, and probably knows the history of the business owner. So if that connection disappears, lending to small businesses will disappear as well. Number two, simple economics tells us that reduced supply and the same demand increase prices. So less competition will cause increased costs to the average consumer, but really hurt the underbanked community, which the Federal Reserve says is 22% of adults. They can't even get access to the larger banks today. So they have to go to an unregulated market where there's higher costs, higher transaction fees, higher interest, higher rate of fraud, scam, and egregious loan terms. So is bigger better and lesser more? I would say a resounding no.